Hello, everyone. Welcome back to our channel. Today, we have an exciting topic to discuss, the concept of capital budgeting. In this video, we will be exploring a chapter that covers a wide range of essential concepts. So, grab your notebooks, and let's dive right in. Capital budgeting is a process that businesses use to make decisions about long-term investments in projects and assets. These investments might include purchasing new equipment, expanding facilities, launching new product lines, or acquiring other businesses. The goal of capital budgeting is to allocate the company's financial resources in a way that maximizes shareholder value. Here are some key aspects of capital budgeting. Project identification. The first step involves identifying potential investment opportunities or projects that align with the company's strategic objectives. Project evaluation. Once projects are identified, they are evaluated using various financial metrics such as net present value, NPV, internal rate of return, IRR, payback period, and profitability index. These metrics help assess the feasibility and profitability of each project. Capital allocation. Based on the evaluation, management must decide which projects to undertake and allocate financial resources accordingly. This involves considering budget constraints and the overall financial health of the organization. Risk assessment. Capital budgeting also involves assessing the risks associated with each project. Factors such as market conditions, technological changes, and regulatory issues can impact the success of an investment. Monitoring and review. Even after a project is approved and implemented, it's essential to monitor its progress and performance. Regular reviews help ensure that the project is meeting its objectives and making a positive contribution to the company. Common methods used in capital budgeting include net present value, NPV. It calculates the present value of cash inflows and outflows to determine the overall profitability of an investment. Internal rate of return, IRR. It represents the discount rate at which the net present value of a project becomes zero. Payback period. It measures the time it takes for the initial investment to be recovered through the project's cash inflows. Profitability index, PI. It is the ratio of the present value of future cash flows to the initial investment. Generating investment project proposals. Investment project proposals can stem from a variety of sources. For purposes of analysis, projects may be classified into one of 5 categories. 1. New products or expansion of existing products. 2. Replacement of equipment or building. 3. Research and development. 4. Exploration. 5. Other, for example, safety-related or pollution control devices. Cash flow checklist. Creating a cash flow checklist can be a helpful tool for managing and monitoring the inflows and outflows of cash in a business. A sunk cost is a cost that has already been incurred and cannot be recovered. These costs are typically irrelevant to future business decisions because the money spent on them cannot be recovered, regardless of the course of action taken. In other words, sunk costs should not influence future investment or operational decisions, since the money is already spent and cannot be recouped. Examples of sunk costs. Money spent on research and development for a project that is no longer viable. Expenses associated with a marketing campaign that did not generate the expected results. Costs related to the purchase of equipment that is no longer in use. Opportunity cost. Focus. Instead of dwelling on sunk costs, decision makers should consider opportunity costs, the potential benefits foregone by choosing one alternative over another. Opportunity cost. Opportunity cost is a fundamental economic concept that refers to the value of the next best alternative foregone when a decision is made to allocate resources, such as time, money, or effort, toward a particular option. In other words, it's the cost of foregoing the next best alternative when making a choice. Example. If a person has the option to either work at a job that pays $50 per hour or attend a 3-hour social event, the opportunity cost of attending the event is not just the time spent, but also the potential earnings of $150. 3 hours x $50 per hour.
Depreciable basis. The depreciable basis, also known as the depreciable cost or depreciable amount, refers to the portion of the cost of an asset that can be depreciated over its useful life. Depreciation is an accounting method used to allocate the cost of a long-term asset over its useful life. Here's a breakdown of the key components. 1. Cost basis. The total amount paid to acquire or produce the asset is its cost basis. This includes not only the purchase price, but also additional costs such as delivery, installation, and any improvements that enhance the asset's value. 2. Depreciable basis. The depreciable basis excludes certain costs that are not subject to depreciation, such as land, because land does not wear out, or costs incurred for repairs and maintenance. It represents the amount on which depreciation will be calculated. 3. Useful life. The useful life is an estimate of the number of years over which the asset is expected to contribute to the company's operations. Depreciation is spread out over this period. 4. Depreciation method. Various depreciation methods, such as straight-line depreciation or accelerated depreciation methods, like MACR's Modified Accelerated Cost Recovery System, are used to distribute the depreciable basis over the useful life of the asset. Capitalized expenditure. A capitalized expenditure, also known as a capital expenditure or capital expense, refers to a cost incurred to acquire, improve, or extend the life of a long-term asset. Instead of treating the expenditure as an immediate expense, which would be deducted from income in the period it is incurred, a capitalized expenditure is recorded as an asset on the balance sheet. Here are some key points about capitalized expenditures. 1. Nature of expenditure. Capitalized expenditures are typically associated with the acquisition, improvement, or expansion of long-term assets such as property, plant, equipment, or intangible assets. 2. Recognition as an asset. Instead of being expended immediately, the cost is added to the balance sheet as an asset. This allows the business to recognize the expenditure over the useful life of the asset through depreciation or amortization. 3. Examples of capitalized expenditures: acquisition of property, purchasing a building or land; improvements, renovations or significant upgrades to existing assets; equipment, purchase, buying machinery or vehicles;